All right, let's dive into a strategy that a lot of really savvy investors use, not just to generate some extra income, but to buy great companies at a serious discount. We're going to unpack the whole world of selling put options. So let me just ask you this straight up. What if you could get paid? I'm talking cash deposited right into your account just for agreeing to buy a stock you already like, but at a price that's even lower than it is today. Sounds pretty good, right? Well, that's exactly what we're talking about here. You know, the best way to get your head around this is to totally flip your mindset. You're not just an investor anymore. No, for this strategy, you're the insurance company. You are literally selling an insurance policy on a stock. And just like Geico or Progressive, you get to collect a fee for providing that coverage. So how do you actually get paid? Well, by stepping into that insurer role, you get to collect an upfront fee. In the options world, they call this a premium. And the best part is, you get that cash in your account right away, just for making the agreement. So what in the world is selling a put? It's basically a contract. You're making a promise, an agreement, to buy 100 shares of a stock at a very specific price. That's the strike price. If the stock happens to drop to that level by a certain date, and just for making that promise, you get paid that cash premium immediately. Now, every insurance policy has terms and conditions, right? The fine print. So let's break down the details of the policy you're selling so we're absolutely crystal clear on what you're actually agreeing to. Okay, this slide is really where the magic happens because it shows the complete role reversal. See, most people think about buying a put. That's where you pay the premium to get the right to sell your shares. It's like buying car insurance, but we're doing the exact opposite. We're selling the put. We are the ones collecting the premium, and in exchange, we take on the obligation to buy. We're not the customer here. We're the house. We're the insurer. Think about it. A good insurance company doesn't just insure anyone or anything that walks in the door, right? Of course not. They have super strict rules. And if you want to be a successful put seller, you need your own set of underwriting rules to manage your risk. So here are the 3 golden rules. You have to follow these religiously. First, and this is the big one, only sell puts on companies you would be genuinely thrilled to own. Just think of it as a smarter way to place a buy order. Second, always, always know your real cost. Your net price isn't the strike price. It's the strike price minus that sweet premium you collected. And third, don't go crazy. Manage your risk. Don't bet the farm on one trade. Keep the total cash you might need to a reasonable slice of your portfolio. This quote really just drills down on the most important rule of all. This is not about some random speculation, okay? It's a very targeted strategy for buying shares in high-quality companies you've already done your homework on, but at a price that's even better than what everyone else is paying. Okay, enough theory. Let's put this into practice and see how you actually make money. When you sell a put, there are really only 2 main ways it can end. I like to call them the payday and the payout. So let's imagine there's a stock. We'll call it company ABC, and it's trading for $100 a share. You like the company, but you think $95 would be an even better entry point. So you sell one put option with a $95 strike price, and bam, $300 in cash premium appears in your account instantly. Now for the first outcome, the payday. If company ABC's stock price stays anywhere above your $95 strike price by the time the contract expires, the option just expires worthless. The person who bought it from you won't use it, and you just keep the entire $300 premium, no strings attached. That's a quick 3.2% return on your secured cash, just for being patient. But what if the stock does drop below $95? Well, this is the payout scenario. You simply do what you promised. You buy 100 shares at $95 each. But hold on. Remember that $300 premium you collected? That effectively lowers your cost. Your actual net cost per share is only $92. You just bought that stock you wanted at an 8% discount from its original price. See? It's a win-win. But we have to be honest here. Just like in the insurance world, there are catastrophic claims. And this is why those underwriting rules we talked about are so incredibly important. Let's say you get a little greedy with some company XYZ. You sell 10 contracts at a $40 strike and collect a really nice $5,000 premium. You're feeling pretty good. And then, disaster. The company gets hit with a massive fraud investigation. The stock is plummeting towards zero. Well, guess what? You are now obligated to buy 1,000 worthless shares at $40 a pop. That means you have to shell out $40,000.
And even after you subtract that $5,000 premium you were so excited about, you were still staring at a staggering $35,000 loss. This is the risk. This is the fire. And this is exactly why you only sell puts on quality companies you genuinely want to own for the long haul.
Any smart insurer adapts their strategy based on the weather forecast, right? They don't write the same policies during hurricane season as they do on a calm, sunny day. And as a put seller, you've got to learn to adapt your approach to different market weather conditions. So in a bull market, when things are calm and the sun is shining, premiums are usually lower because there's just less fear to go around. The key here is patience. You have to be selective. You wait for those temporary little dips in really strong stocks, and then you sell puts way below the current price to give yourself a huge margin of safety. Now, during a bear market, the weather gets stormy. Fear is through the roof, which means premiums get jacked way up. This is where you can get paid really, really well, but the risk is obviously higher. Position sizing is everything here. And a fantastic tactic is called laddering. That's when you sell puts at different lower and lower strike prices. That way, if the stock keeps falling, you're buying shares at better and better prices on the way down. And what about this kind of boring sideways markets, where a stock seems stuck in a rut? Well, for a put seller, this is like a predictable, stable season. It's often easy to see clear support levels, prices where the stock has historically hit a floor and bounced back up. Selling puts right at or just below that support level can be a super high probability trade. Look, if you only take one single thing away from this whole explainer, please let it be this. Don't think of this primarily as an income strategy. That's the wrong mindset. The real goal, the main purpose, is to acquire shares of great companies you want to own anyway, but at a discount. That premium you collect, that's just a fantastic side benefit that lowers your cost even more. Which really leaves us with a final question for you to think about. After seeing how this all works, the good and the bad, do you see this as just a way to generate income? Or is it something more? Is it a fundamentally more intelligent, more patient way to build a portfolio of stocks you truly believe in? The answer to that? Well, that's going to shape how you might decide to use this yourself.